Hello guys, welcome to Swadhyay for CA. So without any delay, let us go to the revision of first chapter of direct taxation, that is basic concepts. First, let us discuss few points which you may not find relevant for answering comprehensive questions, but these can fetch you marks if asked in MCQs. First question, why is tax levied? So people pay tax as a cost of living in a society. And who levies these taxes? Of course, it is government, and government levies and collects taxes to meet the common welfare expenditure of the society, like defense, healthcare, or infrastructure. The Constitution of India, in its Article 366, Clause 28, defines taxation as follows. Taxation includes imposition of any tax or impost. I repeat, imposition of any tax or impost, like late fee, interest, etc. It may be general or local or special, and tax shall be constituted accordingly. What are the types of taxes? Generally, we have direct taxes and indirect taxes. Direct taxes are levied on income or wealth of a person, whereas indirect taxes are levied on a price of a good or service. In case of direct taxes, payer cannot recover the tax from somebody else. That is, the burden of tax cannot be shifted to another person. In case of indirect taxes, payer passes the tax incidence to another person. The burden is shifted to another person. A good example of direct tax is income tax, whereas GST and customs duty serve as good example for indirect taxes. Coming to the next slide. Who pays taxes? Assessee is the person who pays taxes as per our Income Tax Act. The person by whom tax or any other sum is payable under this act is an assessee. It also includes every person in respect of whom any proceeding under the Income Tax Act is taken, and that proceeding may be for assessment of his income or income of other person, but this person will be assessable on that person's behalf. I repeat, the assessment is of his income or income of any other person in respect of which he is assessable, or the loss sustained by him or by such other person, or the amount of refund due to him or to such other person. Also, if any person is deemed to be an assessee, or he is deemed to be an assessee in default under any provision of this act, he is considered as assessee in our Income Tax Act. Now, next let us discuss what is assessment. Assessment is the procedure by which the income of an assessee is determined. So far we have discussed what is a tax, what are the types of taxes, and who pays these taxes. Now let us discuss who levies taxes, who has the power to levy tax. The Constitution of India, the supreme law of India, has laid down in its Article 265, repeat with me guys, the Constitution of India has laid in its Article 265 that no tax shall be levied or collected except by the authority of law. It means that if you have to levy a tax and collect it in first place, there must be a law framed. If you have to levy a tax, there must be a law framed before. So, the Constitution of India has divided the work of levying and collecting taxes and making laws for taxes between the governments and parliament and state legislatures. So the law will be made by parliament and state legislators first, and accordingly central government or state government are empowered to levy and collect taxes. So first parliament and state legislatures will make a law for taxes, and then central government or state government will accordingly levy and collect the taxes. Okay, now on what matters parliament makes laws and on what matters state legislature makes laws? To answer this question, Constitution of India has mentioned 3 lists. There are 3 lists, namely Union List, State List and Concurrent List, in the 7th schedule to Article 246. Repeat with me guys, in the Article 246 7th schedule, there are 3 lists. The first one is Union List, which has matters on which only Parliament can make laws. That is what exclusive power means. Only Parliament has exclusive power to make laws on matters contained in the Union List. And only state legislatures can make laws on matters contained in the State List, the second list. And then comes the Concurrent List. Both Parliament and state legislatures have exclusive power to make laws on matters contained in the Concurrent List. Okay, now since our subject is income tax, who has power to make laws related to income tax? Is it Parliament or state legislatures? That is none other than our Parliament. So entry 82 of Union List has empowered Parliament to make laws on the taxes on income other than agricultural income. So tell me guys, who has the power to make laws on income other than agricultural income? Parliament has the power. How Parliament got such power? Through entry 82 of Union List. Okay, now let us go through a topic which can be asked as a comprehensive question. Apart from Income Tax Act 1961, there are few other aspects which play a key role in fulfilling the purpose of the Income Tax Act. Those are covered in overview of income tax law as follows. So guys, this is the overview of income tax law in India. We have Income Tax Act 1961, the Finance Act, Income Tax Rules 1962, circulars and notifications, and legal decisions by courts. We know that Income Tax Act 1961 has come into force on 1st April 1962. It extends to whole of India and contains section 1 to 298. Repeat with me guys. Till now we have sections 1 to 298 and 14 schedules in our Income Tax Act 1961. This act is not static, that is, it is amended every year. Additions are made to Income Tax Act or amended through the Finance Act. The Finance Act is nothing but a finance bill, a bill introduced by our finance minister in Parliament budget session. Once this bill is passed by Lok Sabha and Rajya Sabha and the assent of President is received, it becomes Finance Act. Not only Income Tax Act but other tax laws are also amended as per the changes brought in by the Finance Act every year. It is in this Finance Act the rate of taxes, the rates of TDS are specified every year. Now comes Income Tax Rules 1962. These rules are introduced from time to time by Central Board of Direct Taxes, which is vested with the administration of Income Tax Act 1961. Then comes circulars and notifications. Circulars act as a guidance for both officers and assessees. Repeat with me, these circulars act as guidance for both officers and assessees. These are issued by CBDT and they bind the department. But the assessee is not bound by these circulars. He can take the advantage of beneficial circulars though. So repeat with me guys. Department is bound by the circulars. Circulars are not binding on assessees, but they can take advantage of beneficial circulars. Notifications. Notifications are issued by central government. CBDT is also empowered to issue notifications, and these notifications are binding on both department and assessees. So circulars are not binding assessees, but the notifications are binding on both department and also assessees. Then comes legal decisions by courts. Case laws. These are nothing but the decisions given by court in any specific dispute arising between assessee and the department. Guys, you can present this as an answer if a comprehensive question has been asked in the paper on this topic. Now let us discuss the backbone of the Income Tax Act, that is a section because of which a person is liable to pay tax. It's none other than section 4, charge of tax. So guys, as I have stated just now, section 4 is the backbone of Income Tax Act 1961. It states that tax is charged as per the rates prescribed in Annual Finance Act or Income Tax Act 1961 or both. Then it states that the charge is extended to every person mentioned in section 2 clause 31. Also, the tax is chargeable on total income earned during the previous year, not assessment year. Guys, section 4 states at what rate the taxes are charged and on whom taxes are charged and on what, that is the total income of previous year, the tax is charged. We have come across two terms. One is previous year and one is assessment year. So what is this previous year and assessment year? Previous year is nothing but the year in which income is earned, and such income is assessed and is taxable in the following year, immediately following year, which is called as assessment year. If 2023-24 is previous year, the assessment year will be 2024-25. Assessment year will always start from 1st April and it is a period of 12 months. We have to consider financial year for previous year and assessment year instead of calendar years. Let us take an example. There is a newly set up business or profession. Let us say on 1st October 2023. What is the previous year? What will be the previous year for the assessment year 2024-25? The previous year will start from 1st October 2023. That is the date of commencement of business till 31st March 2024. That is the end of the previous year. So for newly set up business or profession, previous year shall be from the date of setting up of the business to the ending of the year. That is 31st March of the financial year. So guys, we have discussed a general rule in section 4, that is the total income earned during the previous year is chargeable to tax. But there are few exceptional cases to this statement. There are cases where income of previous year will be assessed in the previous year itself. That is in case of number 1, shipping business of a non-resident. Let us take an example of Mr. A, who is a non-resident situated outside India, and his ship is right now at Indian port. It contains goods or livestock or passengers, and for this ship to leave Indian port and reach Mr. A, he has to pay tax. On what amount Mr. A has to pay tax? For the income tax purposes, 7.5% of freight paid or payable to the owner on account of such carriage of goods or livestock or passengers is deemed to be his income, and such income is charged to tax in the same year in which it is earned. Second case, person leaving India. When a person is leaving India and it appears to assessing officer that he has no intention to return, the assessing officer may ask the person to make an assessment of the total income earned by him in the previous year and pay tax on such income. Number 3, association of persons or body of individuals or artificial juridical person formed for a particular event or purpose. On fulfilling of such purpose, it seems to assessing officer that the entity is likely to be dissolved in the same year or next year. In such cases, assessing officer may make an assessment of the income up to the date of dissolution as income of relevant assessment year. Number 4, persons likely to transfer property to avoid tax. A person, in order to avoid tax under Income Tax Act, is trying to charge, sell, transfer or dispose any of his asset or property. In such cases, assessing officer immediately commences proceedings against this person. Number 5, discontinued business. Where any business or profession is discontinued in any assessment year, the income of the period from the expiry of previous year up to the date of such discontinuance may be charged to tax in that assessment year itself at the discretion of assessing officer. So guys, this is it for today. Let us discuss the further topics of basic concepts in our further videos. Thank you.